Other parts of the world are definitely still struggling. So Japan, UK, and Germany all are around roughly negative 1% GDP. The big thing is per capita, they're about the same.
Yeah.
Australia's GDP is up 1%, but per capita, it's still back 1.5%. But the big rock star right now is the US, where their per capita and actual GDP are both sitting at 3 to 4%. So really strong numbers. And obviously, the US has a big impact to how the whole world is feeling.
Yeah.
So some good news globally, which just really talks to the point about diversification with investments.
Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair. And today, our quarterly update.
So on a quarterly basis for all of our investment clients, we do a quarterly update.
We do.
And we put it on the website. We put it behind a password. And I thought, Mike, why do we do that? Why don't we just turn it into a podcast? So today is really all about talking about the markets, global economics, the share market, about what is going on and what do we think is going to happen next.
Yep.
So Mike, where do we want to start?
I reckon let's give an outline of why we're doing this and what customers can expect from it, whether they're investment or otherwise.
Yeah, so I think a really important bit with any sort of market update is you shouldn't do anything with it.
Yeah.
So often people want to go, what's the hot tip and what is the investment decision I'm going to make off it? We're going to talk about what's happened over the last quarter, the last 12 months, what we think is going to happen moving forward. But the bottom line is, Mike, you should still do nothing with the information,
You
right?
shouldn't go and shave all your hair off just because the markets have dropped a little bit.
I tell you what, though, you can pull off any look.
Cool. Okay, so let's start with your global outlook. Where are you at with the moment with the share market in particular?
Yeah, so it's quite interesting because in a lot of the episodes we do, we talk about property. And as a mortgage broker,
Property.
as a mortgage broker, it's a little bit sad at the moment. House prices are low, interest rates are high, inflation is still high. You keep throwing money at mortgage repayments, you look up the valuation, and property's still going down. That is not the story with the share market.
Tell me more.
Whatsoever. So over the last quarter, the global share market has increased 15% for the quarter and is up 30% over the past 12 months. A big part of that growth is to do with growth stocks.
Yep.
So growth stocks are essentially, instead of focusing on getting a dividend, we think the value of the company is going to increase over time.
What type of stocks are we looking at for that?
Mainly the tech stocks are the big ones.
Yeah.
So it's the Magnificent Seven, which include like Microsoft, Nvidia,
Amazon.
Tesla, Amazon, Apple. They have done a lot of the hard work.
Yeah.
AI stocks have jumped 50% since Jan 2022.
Yeah.
So, and that's for all of them, right? And there's going to be some winners, but there's definitely some losers
We
in
should
there as
start
well.
up Lighthouse AI and list it.
Look, I've tried. That's why we got Ravi working on that 24/7. We put him in a basement. So that is a crazy number for the market to jump 30%. And we're certainly seeing that in terms of our reports for clients over the past quarter and the past year.
Yeah.
And it's a really good reminder. And for those with property and feeling a bit sad, a little bit behind us, which, sometimes the property guys are, it's a really good reminder that bad times don't last.
Yeah.
The whole time where we were seeing, the share market dropping 20% for a year, my message was very consistent. It is not going to last forever. We are going to see a rebound. So it is really nice to see a lot of our portfolios performing really well.
Yeah.
So our defensive portfolios jumped 7% over the past 12 months. So that's well above term deposit rates. A moderate portfolio, which has 40% in shares and properties, 60% in cash and bonds, is up 9%. And a balanced portfolio, which is that next level of risk, is up 10%. And if you move on to the KiwiSaver side, there are some insane returns for the more aggressive funds. So the Milford Aggressive Fund and the Booster Socially Responsible High Growth Fund have both jumped 20% over the past 12 months. So they have some very big numbers.
What are some of the underlying factors that mean that they grow so much more than, say, your balanced fund? And I know a defensive has a much higher allocation to cash, but why are those high risk funds growing so much more at the moment?
It's just the high allocation of shares.
Yeah.
So like an aggressive fund or a high growth fund has 95 to 99% in shares and property.
Yeah.
So that means, and when we talk property, we're not talking resi stuff. We're talking infrastructure, airports, toll roads, very different types of properties, some commercial stuff as well.
Yeah.
So you get those good returns, But when you have a COVID or a global financial crisis or a 1987 stock crash, chuck your seatbelt on because you're going on for a bumpy ride.
Yeah.
And that's the really big thing. And probably my concern is people start to look at these returns and they go, I'm going to ramp up the risk.
Yeah.
And that's not usually what happens. Like we saw, and you've got that really good stat during COVID, all the Kiwi savers. What were the number?
I think it's like 3 or 4 billion or something came back from high growth to defensive portfolios.
Yeah, which is
the wrong time to do it and the wrong thing to do.
Yeah. So portfolios performing really well. The share market is jumping really high overall. The one that's trailing a lot is the NZX 50, which is not particularly surprising.
Is that ever exciting?
No. Well, it's
all 3 companies.
Yeah, that's right. Well, actually, Mike, there's 50 of them.
Sorry.
So that's jumped 3% for over the past 12 months. The reason why it's so far behind, one, is we don't have any sexy AI companies, although the first one got listed on the NZX, I think, a couple of weeks ago. But, we've got poor GDP numbers, which we'll talk about that in a second. We've got high inflation and we've got high interest rates. And it is very much related to how the country is performing, has a big impact towards the stock markets, obviously.
Yeah.
The country is made up of businesses.
I mean, everything you kind of talked about there is a recipe for, a fairly sluggish economy, those high interest rates, low GDP numbers. I mean, but like James said, these times aren't going to last forever. It will kind of snap back as interest rates start to trail off again and GDP picks up. So we've talked about GDP a little bit, but before we move on to that, is there anything else you want to cover off with the share market?
Yeah, I mean, just the last little bit to touch on is markets are doing well because of the combination of US stocks performing really well. The other big piece for the more defensive portfolios is bonds. Like a couple of years ago when interest rates were really low, bonds are far more sexy than they used to be, Michael. So pretty much all bond yields are delivering a higher return than term deposits, which is really positive. Australian equities doing 16% over the past 12 months. So nice to see Big Brother's doing a little bit better than us. Not. And global property, while we talk about New Zealand property performing quite poorly, global property has still done 9% over the past year.
Yeah. What's the reason those Australian equities are doing so well? Mainly their economy has that exposure to the mineral and mining sector and the demand from China. Is that still in play or what's happening there?
Yeah. So we're about to talk about the GDP numbers. Essentially, the growth in Australia, they've rebounded far better from high interest rates and COVID than New Zealand has.
Well, let's jump into that GDP then. So gross domestic product, we talk about it all the time. James, give me a quick rundown of what it is. And then let's dive into it.
Yeah, GDP is pretty simple. A country makes and sells stuff. So are you making more stuff? Are you selling more or are you selling less?
Yeah.
So if we think about employment, businesses, how are they performing, whether they're selling a service, whether they're selling a product, as a percentage, are we doing more? Are we doing less as a country? Obviously, then we get taxed on those profits. Unfortunately, that gives the government money that they can reinvest and pay off all of their debt. So the problem is, we've been talking a lot about, just before I talk about New Zealand, a little bit more about the States. So once again, the story with the States is quite different because over the past 3 quarters in a row, actuals have beaten forecasts from analysts in terms of US company earnings. Yep. So essentially analysts have gone, this is what we think these big companies will do, and they've been performing better, which is obviously great for the economy. Unfortunately, when it comes to New Zealand, we've been talking a lot about the recession that we're in at the moment. Maybe it's not too bad. Some people use the word technical recession. Do you think we use the word technical recession to make ourselves feel better? Or
I don't know. I mean, technically, either you're in a recession or you're out of a recession.
Yeah.
I don't know.
I reckon it's kind of like, well, technically I got a parking fine, but it wasn't that bad.
But technically people are losing their jobs, unable to afford their mortgages. So it feels like a real technical recession.
Yeah.
Yeah.
God, I'm talking to so many people at the moment who are being made redundant. It definitely feels like that last bit of
pain,
is getting squeezed out.
Yeah. The amount of interest only and loan extension requests I've got at the moment there's a lot.
Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below.
Coming back to that point, so we know that New Zealand is in a recession, which means we've had 2 quarters of negative growth. Our GDP over the past, over 6 months annualized is negative 1%. The big problem, Mike, is we're having more people join the country than leave the country, and we are still in a recession. So while our GDP is negative 1%, our GDP per capita, which is the growth that we're making as a country divided by the number of people, because we've got more people, our GDP over 6 months annualized is negative 4%, which in the OECD is one of the very worst, which is pretty concerning.
Yeah, and it's not great news. And I mean, like we sort of said just before, this really feels like the tail end, that really sharp sting before there is some relief in the economy. So we're all hoping that, this is as worse as it's going to get and it's going to turn around. So in terms of the US GDP and New Zealand GDP, obviously Australia is doing a little bit better than us. Why do we care about GDP so much?
Well, it's the pulse of how we're doing, right?
Yeah.
Like if you think about we talk a lot about, and you see, we should be doing more taxing. We should be taxing property investors more, businesses more, people coming into the country more. That is not how a country grows. A country grows by having strong GDP. So we've got good businesses, giving good jobs, giving people pay rises, making it more enticing to do business with New Zealand. That means we can have more tax to invest into our roads and our schools and our hospitals. That's why it's also important. If GDP is not going well, nothing is going well.
Yeah, and it's really interesting as you kind of look at the mixture of, I guess, businesses in the economy and how different sectors are responding differently to these high tax or these high interest rate demands, right? You have a manufacturing and a retail sector, which is getting absolutely slammed. We're now starting to see that drip into the services sector. And if you look at the ways that economies advance over time, you start as agriculture, then manufacturing, and then service economies. And that was the track that New Zealand was on. And it almost feels like all of that growth has just been absolutely halted and everyone is retrenching in their businesses.
Yeah, I mean, you think about the times where we were thought of as a real innovation hub, that we were referred to as like a rock star economy at one point. It certainly feels like we're a long way away from that at the moment. And then if you compare to some of our peers, so other parts of the world are definitely still struggling. So Japan, UK, and Germany all are around roughly negative 1% GDP. The big thing is per capita, they're about the same.
Yeah.
Australia's GDP is up 1%, but per capita, it's still back 1.5%. But the big rock star right now is the US, where their per capita and actual GDP are both sitting at 3 to 4%. So really strong numbers. And obviously, the US has a big impact to how the whole world is feeling.
Yeah.
So some good news globally, which just really talks to the point about diversification with investments. If you have all of your money sitting in a small island nation, which has natural disasters and is very dependent on, say, China, for example, there's risk. But if you have good diversification to different countries, different industries, different asset classes, it provides a smoother ride.
Yeah, I was listening to a Magellan talk on geopolitical risk a couple of months ago, and it is absolutely fascinating how the interdependencies of smaller countries on large countries really depend, like just how much it means for that economy and how every word they say when they're talking about, like, oh, we're not slamming China for this, or we're not saying this about the US. Yeah, there's a very good reason for that. It's because as soon as some tariffs comes up, everyone in the country is affected. So we've talked about GDP. We've talked about the share market. What are you thinking for your outlook? Give me the prediction. Give me the crystal ball.
Yeah. So when we're thinking locally, I mean, as we've kind of alluded to, we're not there yet. We've got some more pain to go. Inflation is still at 4%, and inflation is the real number. Whether you are a personal, you're a family or you're a business, high interest rates aren't really good for anybody, because high interest rates stop businesses from wanting to invest as well. Because they go, maybe when interest rates are 2 or 3%, they'll go, I will take that loan, invest in my business, grow, hire more people, create new products, do interesting things. At 7% interest rates, everyone's like, let's just wait, see, maybe let's do a restructure to save some costs, make sure the business is in good shape.
Yeah, well, if you think about the way that most, the majority of business in New Zealand are small to medium-sized businesses, they are mainly funded out of people's home loans backed against the owner's houses. And if that goes from 2% to 7% or 8%, that is the cost of funds, right? So you just simply can't invest. And also you don't have the equity to invest because the value of your house has come back. And to your second point there, never waste a good crisis, right? People are restructuring. They had to hire a lot of staff during 2020, 2021 at quite high salaries. They now have the opportunity to cut a bit of the fat out of their business, restructure people out, and try and reduce that wage bill a bit. Yep, it's not the prettiest thing to be doing, but sometimes if you're not getting the leads coming in the door, you're not getting the sales, you've got to do something to save costs. Now might be the time to do it.
Yeah, it's actually interesting you say that. I was talking to a business owner with maybe 30 employees, and he was saying at 2021 when, remember it was like the quiet quitting and job hopping and, have two jobs at the same time and all that kind of stuff. And he was talking about the and this was mainly like a contracting style business. The incomes people were requesting were just insane, and businesses had no choice but to say yes.
It was so tight in the labor market.
And now you look at the labor market and the quality out there, how realistic people are. People are not wanting to jump because they're thinking, it's not a great time to make a move. It just shows that, when it comes to property market, share market, employment market, things go in cycles.
Yeah. So when do you think we will be back on the rate cutting, some sweeter news for the business owners and for mum and dad?
Yeah, I mean, I'm sure you've got some strong opinions here as well. I think probably before the end of the year, we'll be back within the Reserve Bank's band. So between that 1% and 3% over the long term is where we want to see inflation. We want a bit of inflation because it shows the country is growing and good things are happening. But we don't want hyperinflation because, as we've seen in the last couple of years, a cost of living crisis is not good for anybody. So when we're back in that band, I'm hoping we're going to see a interest rate cut, an OCR cut before the end of the year. Do you think that is going to happen?
I think it'll be the last review of the year. Right at the back end, we will start to see a cut. Although, if inflation comes down between that 1% and 3% band in the data, I think you will see the Reserve Bank cut almost straight away because one, they know the data is historical, and two, why stuff around? Just, the economy's in enough pain. They don't want to be doing this. You want a rock star economy. You want nice GDP numbers. You want people to be, enjoying their lives, not, defaulting on loans. So I would say as soon as they get it back between 1% and 3%, they'll cut and we'll be on again.
It feels like there's a lot of pain out
there. There's
a
lot of pain out there.
Can I ask you, what happens, like if I'm the Reserve Bank, if I'm Adrian Orr, what is the risk of waiting too long? Like, because you're saying all this data is delayed. What happens if he could have cut it in, I don't know, somewhere around September and he waits till November?
The risk of waiting too long is not as bad or is less severe than the risk of cutting too early. It's as simple as that. It is far easier to get a country out of a recession or a mild depression, which would all it would ever be, than it is to try and pull back any type of hyperinflation. Yep. So, the risk of hyperinflation at the moment is not much because we're on the way down. However, if the Reserve Bank cuts before it is between 1% and 3%, the next time there is a bout of inflation, no one will take them seriously when they're saying they're going to get this back between 1% and 3% because they'll turn around and go, well, last time you cut it 3.5%. So why should we listen to you this time?
Yeah.
They have to do it.
Yep. It's like dealing with naughty children.
100%.
So the other piece, inflation will come down, interest rates will start to come down. Once interest rates start coming down, house prices are going to jump up. I'm a bit worried about what's going to happen to New Zealand house prices next year. When interest rates start coming down, Kiwis are sitting on their hands at the moment wanting to make moves. We have 130,000 new people to the country and we're not building any houses. It does not feel like a good formula for me, and I want to clip this off and look at it in 12 months' time because I'm a bit worried.
Okay, so we've got, we've talked about the stock market. We've talked about GDP. We've given a few predictions. I'm sitting at home. I got my finger on the trigger. I just heard all this. James, what should I do?
What you should always do, you should not be making a decision based off a quarter or 12 months of returns. You should be thinking about what your long-term plan is. So sometimes I hear people go, I'm going to put money into term deposits because interest rates are high. Term deposits are only high because inflation is high. When inflation comes back, term deposit rates are going to come back and your money is going to get eroded by inflation regardless of where inflation and interest rates are. So it is important that you have a long-term plan. I promise you, markets will go up, markets will go down. Generally, we say markets go in 7-year cycles. So there's 3 good years, 3 kind of boring years, 1 bad year. It's important you don't react to any of them and are planning over the longer term. What is the right decision for me? Where do I want to be in 12 months, 3 years, 5 years, 10 years? What are the goals I am working towards?
100%. So don't forget to like, review, subscribe. James, close it out.
I can't believe you stole my line. We'll see you next time.
Cheers.